Welcome to today's edition of the Real Investment Show podcast. I'm your host, Lance Roberts. RealInvestmentAdvice.com is the website. Our special guest today is Otavio Costa. He's the portfolio manager and partner at Crescat Capital. That website, crescatcapital.net. And of course, we've talked with Otavio before and have featured his work on our website, and always great insights from both him as well as Kevin over at Crescat Capital. Tavi, welcome to the show today. Welcome. How are you?
Thank you, Lance. Pleasure to be here and look forward to talking to you. I'm great. How are you?
Well, it's good. You know, we're all hunkered down. We're all living the life of quarantine at the moment. And, you know, as we talk about this, you know, you and I have been writing for a while about the concerns of the markets. You know, in 2019, you know, the markets were rising, and, you know, you were putting out some great commentary talking about the risk to the markets and, you know, the extension of the markets where we were. I was doing a lot of the same things, kind of warning investors about, hey, you know, be careful here, because while it seems as if everything is all great and we've got Federal Reserve liquidity, of course, the mantra was don't fight the Fed. You know, we were warning that an exogenous event, something that the market was not prepared for, something that would completely, you know, pull the rug out from underneath the markets, could cause a rather sharp decline in the value of the markets as well as the economy itself, and trip the economy into a recession. The virus happened to be that exogenous event. So I want to spend a few minutes with you today to talk about, you know, the run up to where the markets were, the impact of the virus, and what the outlook is over the course of the next few years. In, you know, in your opinion, as we get through this, we have some rather unprecedented Federal Reserve actions in terms of liquidity, all these things. How is this going to affect investors? So, Tavi, leading up to the crash, what was your biggest concern?
At Crescat, we build a lot of macro models to sort of identify where we are in the business cycle. One of our main models was flashing that we're very late in the cycle, really back in 2018 or very early in 2018. Prior to that sell-off we had in January, and then the fourth quarter sell-off as well. And I think that those kind of caused some structural damages in equity markets overall back then. Then the macro indicators just kept deteriorating throughout the whole 2019, but we saw markets melting up during that whole year. It was kind of interesting now. You know, we're seeing this coronavirus as sort of being what really burst the whole bubble. But when you look at corporate earnings, you know, they're already contracting back in 2019. You know, the labor market was already starting to show some cracks back then as well. We've had a list of macro indicators already showing issues, especially in places like China as well, which has been responsible for you know, a large portion of the growth in global GDP since the global financial crisis. But overall, what we saw was a distortion between prices and fundamentals here in the U.S. And something had to catch up from one side or another. Either prices had to catch up to the downside, or fundamentals had to catch up to the upside. We're now seeing the prices down significantly from where we were in the peak. The real question now that everyone wants to talk about is this a bottom or not? I have my strong opinions on that too. But what we saw in 2019 that I think gave us the big conviction to stick with the shorts was the yield curve inversion problem. We built here at Crescat a more comprehensive way of looking at yield curve inversions rather than just looking at one or two or three yield curve yield spreads. We looked at all the 45 possible spreads in the yield curve, and what we saw was that 73% of the yield curve was inverted back in August of 2019. Every single time we hit that 70% handle in that, I mean, it either coincided or preceded with a recession. Why this time would be any different, especially from record valuations historically, from almost any fundamental you can look at. So we stick with the shorts, and I can talk a little bit about what are the assets that we thought that would outperform and ways that we thought would be hedging this melt up in the markets back then, which was precious metals at the end of the day. Mm-hmm. And now, you know, it's more of the lag of the equity markets have been declining and showing some issues that we're now focused on.
One thing that you were writing about, I was writing about as well, is that, you know, the yield curve was inverting in the summer of 19. headlines are everywhere. Yield curve inversion means a recession is here. And we were saying this like, no, it's not the actual inversion of the yield curve. It's when that curve uninverts that typically signifies your start of the recession. Our Model 2 was 70% inverted back then. We were suggesting that, hey, this is going to be a problem. And the reason that you were going to have this yield curve uninverted is because the short end of the yield curve was going to collapse faster than the long end. It would steepen the yield curve, but that is typically what happens as you enter into a recession. Not surprisingly, we're seeing that steepening of the yield curve right now, specifically for those reasons. You look at the very, very short end of the yield curve, we actually have very short yields actually turning negative at this point for the first time in history.
It's interesting when you look back in yield curve inversions. There are times when yield curve steepens and it causes a recession after inverting, or sometimes actually the inversion, as it inverts, it also coincides. That's why I always say coincided and preceded. The one thing we found is that the next 2 years after that 70% handle of inversions, empirically, stocks tend to sell off about 27% for the next 2 years. And you can look at treasuries and gold and all sorts of assets to see which one performed the best during those periods. What we found is that gold actually tends to perform the best, especially at times like today with commodities to equity ratio at so distorted historically at a 50-year low right now. So in our view, that was the way to sort of hedge the portfolio and look for a defensive way to play here. It worked back in 2019. Really, precious metals are doing great. This year, not so great. We had some margin calls and issues in the markets, and a lot of people were forced to sell gold and some others. Actually, gold itself has held up very well during this sell-off. It's just other parts of the precious metals like silver and precious metal stocks that really have got hit. But the yield curve inversion is that 70% handle of the total amount of yield curves that actually are inverted. It's incredible. It never failed before. It has a perfect track record, and here we are again today. And I think it's just proven to be right again.
Yeah, let's talk about gold for a second, because you've been very bullish on gold and gold miners in particular. We have too. For a while. There's a very interesting phenomenon that's kind of going on with gold right now, which is that futures are trading well above spot price in terms of the physical gold. And we don't normally see that arbitrage exist for very long. I mean, if I could buy the physical gold and just sell the futures, I could make $25 right now just on that spread. It seemed like everybody would be taking advantage of that arbitrage, which would eliminate that spread pretty quickly. But this has persisted now for a while, and it's kind of perplexing as to what might actually be going on in the gold market.
It's incredible that that spread is perhaps, it's kind of hard to quantify what's really happening, but certainly seems like there's some sort of divergence there. I think gold today, never looks so attractive from so many angles. The only V-shaped recovery we've seen is not on fundamentals, is not on equity markets. It's actually one of them is in gold, especially relative to some other very overvalued fiat currencies like the renminbi in our view. And also, now look at central banks' balance sheets. That's the other V-shaped recovery we've seen. It's gone, from, I think it's about $2.7 trillion that we printed if you accumulate all central banks globally today. You look at Treasury, the whole Treasury curve today is below inflation. How many times that happened? Only once, and that was in 2016 and late 2015 or so. But that back then, the Federal Reserve was actually tightening. Right now, we're massively easing at the same time. At the same time as you have all these negative yielding bonds in sovereign debt globally as well. So I think there's a lot of reasons to own gold. It's perhaps the one area of the market that might benefit from this QE to lunacy sort of or QE infinity lunacy that we're seeing recently. We're very excited about that space. I think we're about to see a secular move there, and we can even see a parabolic move in gold and silver very soon.
Let's talk a little bit about central banks for a second, because that's the question now, right? So the markets rallied in January and February. In March, the wheels kind of came off the cart with the whole coronavirus. Now the Fed has leapt into action. immediately, and to really kind of, and it's easy to say, an unprecedented degree, because they've literally thrown the kitchen sink at whatever they can bail out. They've bailed out treasury bonds, they bailed out banks, they bailed out muni bonds and corporate bonds, and even yesterday announced that they're now going to buy the entire lot of SBA loans that are now going out to the market, which are potentially going to have a fairly high default rate. The Fed's going to take those in as well. We've not seen this type of rapid liquidity response before, and so there's two questions that really come out of this for you. One is that when we do open back up the economy, which we will eventually, this pent-up demand is going to hit at the same time you've got all this liquidity in the market, which will only lead to a very sharp spike in inflation, really trapping the Fed to some degree and the inability to raise rates. But the second component of that is for investors does that liquidity solve the financial issues in the markets and start the next bull leg of the market?
And I think, it's been proven, at least during prior recessions, that money printing doesn't prevent cycles from turning. We saw that in 2006, 2007, and 2008, when central banks are printing, trillions and trillions of dollars prior to the actual decline in the markets, and that never saved the market from really plunging at the time. I think it's the same situation today. We've seen that sort of correlation between balance sheet expansion and stocks kind of breaking recently, which was a big deal for me. But now, there's something that really marked this bull market today, which is this reliance. And it's my view is kind of ridiculous reliance on central banks. They have a terrible track record in the first place of preventing recessions in general. I don't think that's going to be any different this time. In terms of the liquidity issues of perhaps causing inflation, that's a true issue. And at the levels of debt that we have in the corporations and governments today, I think that would be just detrimental for the whole cycle overall. Cost of capital is kept so low and was able to, leave some companies to survive during environments that would never survive. In the 60s or 70s, you wouldn't see Uber surviving with negative free cash flow every quarter, Netflix, Beyond Meat. I mean, those companies would never survive during that decade. They only survive here today because interest rates are so low. But watch those credit spreads; they're starting to increase now, and the cost of capital is going to start rising. There's two ways that you can see cost of capital rising. One is the one you mentioned through inflation, which could be a risk to the overall market, but also just defaults in general and the risk of companies defaulting on their debt, which I think that's what the case is today. But if that happens along with inflation, that would be just the end of the whole cycle. I don't think there's a lot of risk parity funds that are not ready for that kind of environment you're referring to. And I think that's a big problem. Look at what's happening in China today. Inflation is rising in China. It started with the pork prices rising and the inflation in food in general was rising significantly. And now, it's another way to see it. I mean, it's another economy that has debt all the way to the neck. And at the same time, you're having cost of capital starting to rise. So, watch out. The U.S. is in a similar position. It's not very different. The only difference here is that also the government is completely broke. It's another reason why you want to own gold. Fiat currencies are all backed by governments, and all those governments are broke. So, my view, that's the whole reason why you should own gold today.
So basically, what you're saying, Tavi, is that with a country that's going to be running a $3 to $4 trillion deficit, and probably between a 26 and 27 trillion dollar debt, and looking a whole lot more like Japan, investors may want to own some gold in their portfolio. Is that what you're trying to get to here?
Well, let's ask a question. Who is going to bail out who, right?
Yeah.
You look at corporate earnings today, it's not rising at all. They're plunging, and they will be plunging probably in this quarter as well. We're yet to see earnings coming out this week. Right now, so far, Russell 3000 earnings if you look at 12 trailing months EPS, it's down about 7% on a year-over-year basis already. That's prior to the earnings release that's going to come out now. So watch out for that. Now, the other part that governments make money is on household consumption. That's also plunging too. So there's no tax revenues whatsoever. At the same time, you have government deficits or government debt actually are spending skyrocketing. So that's another issue. So deficits are increasing at the same time as economic activity is also plunging today. the way you look at that usually is looking at deficits relative to GDP. That's going to be exploding to the upside, probably to any, we probably haven't seen that in our lifetimes, anything that we're going to see soon here. We're probably going to be very similar to what we saw in the world after the World War II, sort of deficits relative to GDP. I think that's going to start to see issues there. Look at car sales. I just posted this chart yesterday. It's down about 38%. If you look at car sales relative to any other macro indicator, it's so highly correlated to that, GDP or any sales in general of any business. So you would expect that that's going to cause, a cascade problem with every industry in the U.S. So who's going to bail out who? There's a line of industries waiting for the government to give them some support. Airlines, hotels, and you have now even retail sales, auto retailers also in the same issue. So it's going to be interesting to see who is going to be bailed out in the first place. But that that actually means that gold is just in a very, very good position. I do think that gold is perhaps the best asset to own in the long side here.
We're talking with Tavi Costa today at realinvestmentadvice.com. Tavi, one of the things you're talking about here is bailouts. And, following the 2008 financial crisis, the Federal Reserve rushed in to bail out all the banks and to keep the financial system from cracking. Maybe that was good intentions. In hindsight, maybe it would have been better to let the banks to fail. What would have happened at that point is that mid-sized regional banks would have stepped up, taken in those clients. We would have diversified our banking system more. We wouldn't have such a concentrated system of major financial banks at this point. The economy would have recovered, yes, maybe slower, but we probably would have been in a healthier financial position, here a decade later than where we are today. But here we are once again in the middle of this crisis. The economy shut down, and immediately these companies that spent years leveraging up their debt on their balance sheets, using their capital to buy back shares, to increase their earnings per share, to benefit insiders and corporate executives, now are running to the forefront begging the government for a bailout. We've moved to a nation where we used to believe that capitalism was based upon kind of Darwin views, which is the strong survive and the weak perish. And as you were talking about a second ago, back in the 50s and 60s, Uber wouldn't have survived because nobody wanted to drive around in an Impala. But today we don't allow a company to fail. If they're of any size at all, we bail them out. We socialize their losses. We give the losses to the taxpayers and the investors, and we keep the businesses profitable.
Yeah, it's true. Governments and central banks have been able to do that because of one reason, because of cost of capital has been so low, and there has been no cost for printing money so far, besides asset prices being at record levels, which I agree it's a cost too, or it's actually a problem. But that's the biggest thing. I think that there is the reason why money printing will never stop, and perhaps we'll see issues even bailout so many industries is a lot of people talk about the currency markets, but I think the most important market is the treasury market. If that forces the Federal Reserve to act in here, there is a lot of risk parity funds being forced to redemptions because of the sell-off in equity markets. They have to sell treasuries, number one. Number two, you have the government being already having to issue a lot of debt as well. That was the whole issue with the repo markets that we saw back in 2019. So all that is adding up, and the Fed is being forced to step in and purchase treasuries as well. You're seeing that as well in emerging markets, selling treasuries because they have to protect their own currencies. So we're going to see more and more of that probably. I think the treasury market is the most important market. The U.S. and the whole world cannot sustain this debt levels with higher interest rates, number one. When that happens, there's no bailout anymore. I think that's the most important message here. Again, it goes back to gold. That's the one industry. You name an industry that actually is able to benefit from all this money printing. There isn't any besides the precious metals miners. It's the one one industry that is actually trading at the 1980 levels, with historic valuations. It's the one that is separated from the whole overall market at near 20% away from record valuations today. Look at equity markets today. Every multiple you look at is very close to record levels. This is not a bottom at all in our view. This is the middle of the crisis. People say that that's where you make your money is in the crisis moments. Yeah, it's at the bottom of the crisis, not in the middle of it. So I think that this is a moment to be cautious, to use caution, and not to be taking a lot of risk on assets at all.
We've had this 35% decline in the market. There are many, many people in the media, the financial media, talking about, you should have bought the bottom. That was the bottom. And basically, it's all over. As soon as we open the economy back up, we're going to have this big V-shaped recovery in the economy. Everything's going to go back to normal and we're off to the races. But things you don't see normally at bear market bottoms are people chiming to get into the market. Generally, near real bear market bottoms, nobody wants to buy them. There's an old saying on Wall Street, bear markets don't end in optimism, they end in despair. But you're right. You take a look at valuations, still near record highs. Take a look at consumer confidence. That still is not at record highs, but it has not declined that much. And actually, expectations for forward market returns by consumers is near a record high. So that's certainly not something you see in a bear market bottom, but yet here we are, we're having this very nice rally. Kind of what's your view over the next, few months to the rest of this year about how this plays out?
So looking back in history, you haven't seen such a divergence between what the Wall Street thinks about the target price for the S&P versus where the S&P is actually trading today. Everyone thinks it's going to be a V-shaped recovery for asset prices, and we think it's very different. Aside from all the metrics you just referred to, I never seen the markets really bottom at near record levels of consumer confidence. So that's number one. Number two, every time the market bottoms significantly in a crisis or recession, we've had valuations being much lower, supposedly near the median or mean levels historically. This is not where we are today at all. And I think that even more important is the labor markets. It's just starting to deteriorate significantly now. When you look at the year-over-year change, no one is looking at this. The U3 unemployment rate is important. It's at about 4.5% or so right now. Mm-hmm. Now, look at the year-over-year change of that. Every time that rises right now it's close to 16% growth on that. Every time we reach those levels, we had a recession in the past. That's important because usually the average recession lasts about 12 months. And we're just in the first month here this time. I think there's a lot more to go. This data goes back to about 70 years of record. And so it's, I don't think this is the beginning of a lot of investors. Unfortunately, what I'm seeing is that the real investors, the large guys, are already out of the market. Who's coming back, unfortunately, is a lot of the retirement funds are probably going to be coming back and buying this market. That's unfortunate because those are the guys that usually get the pain, and those are the guys usually going to get hurt as well in the pension funds and all that. So that's the part that I get sad about, but it's unfortunately that happens every cycle. They're the ones that unfortunately are late in the story and end up buying this market at those levels, thinking that we're going to be buying the dip again and that's going to work again. That worked throughout this entire bull market. I don't think this is a bull market anymore. I think we broke some very extreme levels of confidence for big dogs in the markets in general. I think they're already out. So I don't think there's going to be, I think it's going to be a continuation of a downturn. It's not going to be a straight line down. I think it's going to look like a lot like 1929, 1930s or so, or the Great Depression. The level of volatility that we've seen is really unprecedented. It really goes back to only 1929 or so. And so I think that in February of this year, it really marked a regime change in volatility overall. I don't think we're going back to normal anytime soon.
So looking at this going forward, and for the retail investor, and again, you bring up pension funds, because one thing that we saw at the end of March, and then really over the last few days here into April, is pension funds rebalancing for the quarter. CalPERS, as an example, delayed their rebalancing until April. A lot of that rebalancing is potentially driving markets here. There is a lot of liquidity sloshing around the market that ultimately has to kind of wind up somewhere. So we can certainly make a case for this rally that we're having this kind of reflexive rally off the lows is really not surprising. I mean, you have a near 35% plunge. So having a reflexive bounce here to some degree, not surprising. But, part of a longer-term bear market is this reflexive rally that resolves itself into kind of a long downward grind. And I want to remind our viewers that in 2008, right after the Lehman crisis, which was a very similar decline to what we just had in March, the markets did bounce a bit as we came in with TARP and TALF. The Federal Reserve was starting to increase liquidity. And then you had another 22% decline in January and February before we got to the ultimate low. So to your point, Tavi, is that there's a real possibility that we've got a good bit more to go. Bear markets don't normally resolve themselves in a month.
There is a good stats on this. Looking at, for instance, money market funds and the mutual funds part, and it's interesting right now. Investors are hoarding close to $4.4 trillion on those funds. That's significant. That's essentially cash on the sidelines if you think about it. The problem is that's about 16% of the total market cap in the U.S. today. Back in 2008, right at the very in the depth of, or at the bottom of the crisis, we got close to 48%. And yeah, the market cap also declines and causes that ratio to rise. But I think that there's a lot more to go. What happens usually is, the market declines and people get scared, they panic, they sell it at the lows, and then markets goes up again. They put the money back to work, and then markets decline. They lose again more buying power, and it just continues to do that every leg of the bear market. Usually, bear markets have many lags. It's not just one. So I think we just had the first one. In the Great Depression, we had plenty actually, and in 2008 we had about 3, I believe. So depends on the recession, the way you look at. They're not going to play out the same way. But I think what's interesting here is about $4.4 trillion is on those money market funds. And when you think about things like the whole precious metals industry, for instance, that's about 4% of. If only 4% of that money goes into that, you buy the entire industry. So if you think about it on a deep value play, that's where I think the real blood on the streets really is. There's blood on the streets in a few places of the market, but not in the overall markets at all. Unfortunately, a lot of people are used to the buy the dip mentality, and they're going to end up doing exactly the same thing, which is buying this latest dip and thinking that we're going to go back to new highs. I'm not sure that's going to happen this time. Matter of fact, we're positioned for the opposite.
Right. So a vast majority of Americans didn't really participate in the financial markets to begin with. They, if you take a look at the stats, 10% of the top wealth holders in the country owned about 84% of the stock market. The rest of the economy, the bottom 90%, really didn't have that much participation. Most Americans had maybe $500 to $1,000 in the bank. They're living pretty much paycheck to paycheck on most bases. And now you've shut down the economy. You've had this very massive increase in unemployment. This is going to lead to a lot of credit card defaults, a lot of auto loan defaults. There's going to be issues with people trying to get back to work. You just don't close a business and then reopen it and immediately everybody goes back to work. There's going to be real long-term sustained damage to the economy. And a lot of that money that's sitting on the sidelines is never coming back. Retirees that had money in 401k plans, they're taking that money out, not necessarily to go put it back in later. They're using it to pay bills, pay mortgages, etc. There's a real possibility a lot of that money never comes back.
True, and also there's a possibility a lot of those jobs never come back either. Well, they will come back at some point, but not in this downturn in this cycle in our view. I think that's another point to add there to your point. Also, we're seeing something that you started to happen really in 2019 that also caused issues in terms of the buying power of consumers and labor markets in general was the private equity market in general. That really started to, it's been a leading indicator for what's happening today. If you look at venture capital activity, it started to really plunge back in June of 2019. It never recovered from it. It's actually declining more and more. Public markets are actually bouncing and getting a relief bounce, but not the private equity markets. That activity is pretty much done. It's actually, if you look at the amount of deals happening today, it's down like 50% or so, something we only seen in the Great Depression, Great Recession. So I think that that's all part of the labor market. It's all linked to the households and how we're going to. Unfortunately, I'm not sure a lot of those jobs are going to come back, and I'm not sure the consumer will have the same buying power it had in the last few years or so.
We're talking with Tavi Costa from Crescat Capital. CrescatCapital.net is their website. Great research. Make sure and follow Tavi on Twitter. He's just a great resource of information as well. Tavi, so one thing that's very important, and particularly here in Houston where I live, is what's going on with oil prices. Lots of hope here that they're going to potentially have a deal between Russia and Saudi Arabia to start to increase production and start to bring things back online. There's really not much incentive here for either Russia or Saudi Arabia to do anything. They've been cutting oil production for years, and my question has always been, how long were they going to cut production while shale producers were cranking it out as fast as they could? Now Russia and Saudi Arabia both have the shale producers kind of on the ropes. I don't really see them giving in here anytime soon.
Actually, oil companies have been one of our biggest shorts back in 2015, 2016 or so, and we actually just switched that position recently. We thought that the bearish sentiment got a little too extreme, and when you look at year-to-date performance for oil, we've never seen anything like we're seeing today in the last 30 years or so.
Right.
It's really crazy what's happened with oil prices. When you look at the forward curve for oil in general, the contango that we're seeing 6 months out, we've never seen before. That actually marked every other bottom for oil. You may ask, how can you be, long oil and so bearish in the economy? Well, I think that there's from a portfolio perspective, portfolio position perspective, you want to be looking for things that have more of the asymmetric upside versus the equity market in case you're wrong about being short the markets. And I think that that's the case here with oil and commodities in general. I think commodities will continue to, or will start to outperform equities in the next few years. Like I said, that ratio of commodities to equities is in a 50-year low. There's a lot of other things. When you look at high yield spreads for energy bonds, for instance, that those spreads are never been higher. Those are spreads that usually when they peak, usually you see those bottoms as well on the whole industry. I don't know how much oil can go down or so, but that's another blood on the streets that we're starting to buy. And we're not buying a lot of the producers that lose money every quarter. We're looking for companies that actually make money and have a healthy balance sheet. There are a few. Yeah. You'd be surprised. And when you look at the S&P 500, for instance, when you look at the weight for energy, I just put out this chart. Very interesting. It's only about 2.6% of the overall weight in the S&P. Yeah. We've never seen anything like that. Last time it actually peaked, it was close to 25%. So I'm just saying, if there's a place where you can allocate capital, that's another one. It's not as much as we're not as with the same level of conviction as we have in gold and precious metals in general, but it's something we started to put some money in.
But let's be really clear about this. You've got to be very careful about where you put your money. There's a lot of these companies that won't exist in the course of the next couple of years. So, there are a lot of these shale drillers, et cetera. They've got a lot of debt. They've got a lot of risk there. So you've got to be very careful, to your point, finding companies with good quality balance sheets that are profitable and can be profitable at lower oil prices.
The whole idea of just passive investment and just buying anything and it's going to go up, it's gone. I think you got to be selective. Either you got to use models or do your own due diligence and looking at the fundamentals very in depth to make sure that you're in good hands in terms of a good balance sheet, a company that actually makes money. It's not easy to find that in oil. Oil is really in a very depressing moment in general. I mean, it's as you know, in Texas, there's a lot of issues there in terms, even right. with labor markets being affected by that. We see this in Colorado too. Whiting just filed bankruptcy, and there, we're probably going to see a lot of those. Now, in terms of oil itself, just a commodity, not just buying just the actual companies. Now, that's all positive for the commodity. If you think about it, that's that's just companies that are going out of business or not going to be producing. So I think there's an argument to be made. Obviously, there's some other issues with excess supply. There's issues with demand, especially caused by the virus outbreak and so forth. No, I'm not. No, I'm not going to argue on that. That's clearly there are a lot of issues with that, and also this whole price war versus Russia, the OPEC, and even the U.S. And that there's no doubt that there's a lot of issues too. But I just think the sentiment got a little too bearish. And if there's a place that where if markets rally here, if I'm completely wrong, and the markets continue to rally here all the way to back to the peak levels, which I don't think it's going to happen. By the way, I think oil could actually recover much faster. That's just again from a portfolio position perspective, I think that sounds a little interesting.
This has been a great conversation, Tavi, and we appreciate your comments and considerations always. And be sure and get by their website, crescatcapital.net. That's crescatcapital.net. And follow Tavi on Twitter because he's got just great resources, puts out great charts all the time. He's just a great resource of information about where we are in the markets and really kind of the risks to be paying attention to. Tavi, really appreciate your time today. It's been awesome. Definitely want to have you back soon to catch up as we continue to go through this cycle. I think a lot of people want to hear what you have to say.
Thank you so much, Lance. It's always a pleasure talking to you, and thanks for the opportunity to discuss my ideas too. Thanks.
Absolutely. We'll talk to you soon. That is the wrap-up of the Real Investment Show podcast. I'm your host, Lance Roberts. We'll see you next time right here at realinvestmentadvice.com.